Hello and welcome back. I'm Claudia Zeisberger, professor at INSEAD, responsible for private equity, venture growth and buyout. Today, though, we will focus on venture capital. The question we're going to try to tackle and unpeel the onion a little bit is, how do venture capital funds come up with a valuation of their portfolio companies, both at the entry, when they make a decision whether to invest or not, and over time, when they are reporting valuation of their portfolio companies to their LPs, their investors. So we will dive in this first part into comparables, checklists, scorecard. But to kick off, let's have a look, how does a VC partner decide, is this company, is this startup backable by my fund? And it clearly has to be a binary decision, yes we invest or no we don't. So first question, does the company address a massive problem? Is the solution needed urgently? Is the solution viable, i.e. can it be commercialized? And then comes the first yes-no conversation. Obviously, if it's a no, the VC will not invest. If it is a yes, then the VC will make an attempt at valuation, because we need to arrive at a valuation for the company to decide what the percentage equity ownership will be, or the allocated ownership to the VC fund. So VCs basically recognize very clearly that valuation in this space of startups is much more a craft even than an art, and certainly not a science. Most of the startups will fail, so the margin of error is huge. I mentioned in earlier videos, about 8 out of 10 of early stage investments in a VC fund will fail. Now, 3 proxies to estimate future cash flow will be obviously the potential market size. We have to make an estimate at that point. The potential market share, how much of that market size will that startup be able to tackle? And what will be the unit economics? What's my margin that I can achieve? Once I have those questions in place, I can potentially even look at future cash flows, or as we call it, future free cash flows as an estimate. And that then gives me an idea if I would like to run a DCF, a discounted cash flow for that startup. So those were basic considerations right at the beginning. So the valuation methods at this initial stage will be different from the ones once the portfolio company has actually entered the portfolio of the VC. Most VCs use various methods and then triangulate or try to arrive at what I call a sanity check of their earlier valuations. So initial valuation stage, we need to decide, are we investing or not, plus ongoing monitoring. So let's have a look at 2 methods, checklist methods and scorecard method. And they are related, as you will see in a second. So the checklist looks at the percentage rated internal measure, and the scorecard compares the internal measures potentially with a premium or a discount for that respective startup. So last round raised, precedent transaction, we will come to those later on. Okay, checklist and scorecard methodology. Let's start off with a checklist. As you can see here, the VC will have developed call it a scorecard, that allows them to assess every startup at arm's length. So, for example, the founder's team. Do they have previous experience as startups? Are they repeat entrepreneurs? Do they have good references? Can we have conversations with some of the people they have worked with before? We then basically will assign a measure, a score for the company. So in this case, this company scores reasonably well with 75%. We will assign a perfect valuation, and then column 1 times 2 times 3 will give me the checklist valuation for this particular key measure. There will be further key measures. So for example, I will look at the idea itself. So founder versus idea. Are you betting on the jockey or the horse? Different VCs will have different priorities between the two. The market, the product and the IP, and ultimately the execution. What you look for in all those key measures is pretty straightforward. But how you basically, what measure, what weight you assign to them will be very much specific to each VC. So as a startup founder pitching to 4 or 5 different VCs, I can expect that each of them will look at my startup with different eyes. So in our case here, this basically company has arrived at a valuation going through those allocated company scores with the respective weightings for the measure that the VC assigns to all its portfolio companies. This one arrives at about a $6.6 billion valuation. This would be, rule of thumb, pre-money valuation of $6.6 million. So how close to a perfect valuation are each of the key measures? So if I look at this company, the founders and team score well with 75%, but there seem to be some doubts about their ability to execute because it ranks at 40%. Now, let's have a look at the SCORECARD valuation method. Similar to the checklist, we have key measures on the left-hand side. So for example, we look at the competitive market. We are basically assessing, is this startup trying to succeed in a blue ocean or red ocean, in INSEAD talk, i.e. in a market that has been highly contested or not contested at all. We then allocate a measure to it. Then we, rather than allocating a percentage measure to the company, we say, does this company outperform or underperform? So I have a premium or a discount to the pre-money median that we have allocated. And then I arrive at a SCORECARD valuation. As a VC, I will do this for all my key measures on the left-hand side. So there is the team strength, opportunity size, product and services, marketing and sales, funding needs, and so on. You will appreciate all those are slightly different, whether you are pitching a consumer startup or a deep tech or AI startup. So I'm just going to fly in the measures, the weights that have been allocated by the fund, and let's see how this particular startup does. So it looks like we're doing okay on the team strength opportunity, meaning we are at a premium, and for the competition. Funding need is about par for the course, and then we have some discounts on the product and services. Again, adding all those up, the SCORECARD valuation gives this company a pre-money valuation of $8.9 million at 100%. So how does this company do relative to the median valuation for a startup in their industry, in their vertical? So clearly they are slightly above the median. So are the key measures at a premium or at a discount? So that's how I basically assess that, and that will form the basis for conversation on the investment committee for that respective VC fund. Now, at that point, we have made, as a VC, a couple of investments. We now have a portfolio of portfolio companies, a portfolio of startups. Every quarter to 6 months of the year, we will report back to our investors, our limited partners or LPs. So how do you get comfortable with the valuations of your existing portfolio companies? So you invested in them, you're going to be on the board, you have them on your roster. How do you revalue your valuation? Let's start off with comps, or what we call a comparable company analysis. So in this case, we're looking at the company relative to peer valuation. So what is a peer company? It's a company that is in a similar industry, running a similar business, similar geography, similar size, and ideally similar vintage. That means similar stage and maturity. The valuation, if recent, could be used as a basis for my evaluation. So if I just invested 12 months ago in a consumer startup here in Southeast Asia, and I know that a recent consumer startup was invested in, I could use that as a comparable. The most commonly used financial ratios at this point, because I mean, obviously, how do I compare those two companies? So we look for financial ratios. Some of the commonly used ones are enterprise value over sales, price to earnings, price to book, price to sales. But obviously, it's rare to find a real peer, a true peer. If every metric was the same, there would be no competitive advantage. There would be no differences between the valuations that VCs put onto those portfolio companies. So judgment, premiums, discounts, allowances are usually necessary. Comps valuations are experience is clearly an advantage. So those VCs that have done this for a while will realize will be probably faster in assessing that. So here is another way of how VCs get comfortable with the valuations they're reporting to their LPs. Let's have a look at last round and precedent transaction analysis. So on the left-hand side, last round transactions, what is actually a transaction? Transaction really counts only if it is, number one, a priced equity round, i.e. not a safe note. Number two, it is an acquisition, could be an acquisition by a trade buyer. Secondary market transaction, meaning we've seen a number of secondary shares change hands at a reasonable price. Now, anything that assigns a price to a round, so safe notes are excluded, as are very small equity rounds by non-institutional investors. We have at times small amounts, small numbers of shares changing hands to small family offices and so on. They do not trigger basically or don't count as a proper transaction. So let's have a look at the last round. So the way this works, you take your own portfolio company, and that portfolio company has just raised an additional round. So we either now iterate or calibrate the price, the valuation that was set by that last round, and based on revenue, burn rate, number of customers, their cost base, their margin, have they launched a new product, do they have any new technology? So those are just some examples on how you can potentially calibrate that subsequent round that was raised by your own portfolio company. Alternatively, we may have heard about a peer startup, and we know that we can derive the valuation that this peer startup has raised money under to our company by using our trusted ratios, enterprise value, sales, and so on. Now, funds are usually quick to mark companies down. They are slow to mark companies up. We've done surveys with various venture funds around the world, and that seems to be a statement I can make with reasonable confidence. Now, if 12 months or more have passed since a last round or a precedent transaction, obviously the validity of those methodologies deteriorate. The longer the time has passed, the less relevant they are. Now, a quick schematic on when do VCs mark up, mark down, or leave valuations unchanged. So, number one, has there been a qualified subsequent financing round? That means a financing round that is larger than the previous round with an institutional lead investor that is considered as qualified. So if no, question is, does the company show signs of impairment? If there the answer is no, that means the company is performing well, has increasing revenue, has a good runway, basically left, then we will leave the valuation unchanged. If the company has a poor performance, falling revenue, increasing burn rate, and so on, then we reduce the valuation to a more conservative future value. Now, if the qualified subsequent financing round has been raised, the question is the round has been closed, documents have been signed, ideally money has hit the bank account, And if there's a no, no change in valuation. That means we're just closing that round, allegedly. If yes, we record the post-money valuation and basically allocate it to the, and update our valuation when we report to our investors. In my next conversation, we will talk about DCF and venture valuation method. Thanks very much for staying with me. I'll see you for the next class.